All right, I think we can begin. Well, thanks everyone for joining us today. My name is Gaby Hui. I am the Director of PR and Corporate Communications at Merkle Science. And today we are talking about a very pertinent topic of the moment, looking to untangle crypto, DeFi, and Doge, what's real for financial institutions. So today we are joined by a great panel. I'll let them introduce themselves in a second, but we are joined by Kanny Lee, who's the Managing Director and Head of Singapore at OSL. Also, Grace Chong, who's of Counsel at Simmons & Simmons, Regulatory and Digital Business Practice, as well as Daniel Lee, who's the Executive Director and Head of Business and Listing at DBS Digital Exchange. And also, last but not least, Ian Lee, who's the Vice President of Business Development and founding team member at Merkle Science. So first of all, why don't I hand it to Kanny? Would you like to introduce yourself quickly?
Sure, thanks, Gaby, and warm welcome to everyone for joining today. My name is Kanny, Head of Singapore for OSL. We're a virtual asset trading firm that's focused on institutional clients. We launched here in Singapore in 2019, and we're one of 3 global trading desks from OSL. As some of you might know, OSL is actually a subsidiary of BC Group, which is a publicly listed company on the Hong Kong Stock Exchange.
Excellent. And then Grace.
Sure. Hi, everyone. Nice to meet you. So as Gaby has said, I cover quite a lot of digital assets matters for banks, asset managers, and tech firms across Singapore and Hong Kong. So we have seen a strong wave of institutional interest. So I think different from the days where I used to support a lot of mainly exchanges and brokers, now I see a lot more funds and asset managers join the game as well. Yeah.
Excellent. Daniel.
Hi, I'm from the DBS Digital Exchange. We are 90% owned by DBS and 10% owned by SGX. We are a digital exchange that offer both cryptocurrency trading and also security tokens. And I look after the business and listing of that exchange. Thank you, Gaby.
And Ian.
Thank you. So as what Gaby kindly introduced, my name is Ian and I'm the VP of Business Development here at Merkle Science. I'm sure Gaby's going to go into this in a little bit more detail, but basically Merkle Science is a blockchain transaction monitoring and intelligence company. And we work with the likes of, any business that has exposure to cryptocurrency, which initially was just, the exchanges, custodians. But like, my fellow panelists touched upon, we are seeing more institutions enter into space, the likes of your banks, asset managers. And similarly, we support them in terms of helping them analyze the risks associated with these digital assets.
Perfect. Thanks, Ian. So just a quick intro on Merkle Science. We are a next generation predictive crypto risk and intelligence platform. And as Ian mentioned, we do help crypto companies, financial institutions, and government entities to detect, investigate, and prevent illegal activities. So we really see our role in the ecosystem as building the infrastructure needed in order to ensure that everyone can transact with crypto safely. So that, crypto businesses, the innovators, the builders, the disruptors can really scale and grow their businesses and focus on what they do best. So without further ado, let's hop into the conversation. So to begin, why don't I bring this to Daniel. Daniel, I really wanted to ask why do you think at this time, with the market being where it is and all the movements we are seeing within the crypto space, why traditional financial institutions want to have crypto exposure besides just FOMO?
Well, I think was digital asset becoming more and more mainstream, it's becoming larger, it's hard to ignore. And if anyone's constructing any portfolio, right, it's very important to have different asset class inside that portfolio for diversification. In modern portfolio theory, you want to look for assets that is weakly correlated to each other. And there are a lot of studies that shows that different cryptocurrencies might be weakly correlated to things like equities, right? And by putting it into a portfolio, you get a more efficient portfolio, right? That is one thing. And I think the other things that you can do that is getting a lot of interest is like there are traditional way of wrapping different assets. Like in the old way, you use an ETF to wrap different commodities like silver or gold, and then you offer it in an easier manner for traditional investors to actually purchase that. And that is a field that a lot of asset managers are actually looking at as well, right? So they could use some sort of an ETF structure. It might not be an ETF, it could be some sort of ETN, right? To wrap some sort of digital asset and then present it in a more traditional manner for traditional investors to gain exposure in this space.
Interesting. And Grace, I know you mentioned that you are hearing from a lot of institutional investors now, like moving into the space. Is that reflective of how you're seeing these FIs move into crypto?
Yeah, sure. So Gaby, when I was attending this panel, I thought it'd be a good chance for me to do a little bit of a time capsule, because looking back in August 2018, I actually wrote an article called "The Rise of the Crypto Hedge Fund." And ironically, then I had thought that there would be an even bigger explosion of institutional activity in 2018, because already then what we were already seeing was that according to Autonomous Next, there were 317 crypto funds with 8 to 10 billion of assets under management then already in 2018. But I think 2021 really marks a big difference now, because we are really seeing a whole board of different kinds of players, banks, as well as asset managers, traditional asset managers, and in different jurisdictions, all being very interested in crypto because of, as Daniel said, the sheer volatility, and as well as different types of interest from investors. So I think this is the year where we have really seen interest pick up across the markets. And also, I think in the last 2 or 3 weeks, it has been extremely volatile, and volatility often also brings about opportunities. Yeah.
That's fantastic. That's, this is definitely a very exciting time. So I will turn it to Kanny now. Wanted to kind of talk to you, as the head of Singapore and OSL, kind of like what are the opportunities that are associated with crypto for FIs, and if there are family offices or funds or high net worth individuals who want to get exposure to crypto, how do you recommend them enter into the market at this point in time?
So yeah, that's a great question. I would say that compared to 2017, in 2021, when you have guys are asking for the first time, how do I get into crypto? Most family offices and most high net worth individuals have been in the crypto game for quite some time. So this is not the first foray. So I guess what we're seeing is that there's more people adding to the position. With the DeFi summer that happened, with the big move in the markets that happened early this year. There's a lot of people adding to positions, but there's a lot of, obviously, like you mentioned at the beginning, a lot of FOMO in the market. So you see the same person is kind of coming in for the first time and say, I want to get my first coin. So we're also dealing with a lot of educational aspect. The more traditional type funds are really looking to come in, moving generational money and getting a larger allocation or new exposure to different coins. But what I find interesting is that they're not coming in asking, should I buy Bitcoin or should I buy Ethereum? They want to know what the next flavor of the month is. Should I get some Doge? And that's when we really talk about wealth creation. And I think that's a really, really hot topic, because when you look at Doge, let's say a few years ago, they were not even in the top 500. It started out, as we all know, a meme. This is something as a joke, and it became a serious currency. So as it moved up and it became more popular, as we had celebrities tweet about it, we had Mr. Musk, talk about it on Saturday Night Live. All that came to a head, and it started promoting this idea that maybe Doge can actually beat Bitcoin, and that really, really generated a lot of interest. And probably amongst a lot of circles, everyone was saying, "Do you have Doge?" And when you go back to sort of wealth creation, that's where it really is, because Bitcoin's sitting at #1 in coin market cap today, and it's the most widely held. So a lot of people use it from a asset inflation, hedge. So not using it really for wealth creation. You could say you can store it and you can hand it off to the next generation. But when you talk about creating wealth today, which obviously most people in the crypto really, really want to talk about, they're looking at, perhaps maybe the bottom spectrum of the top 100 coins and seeing if that will move up. I'll give you a story. Actually, a good friend of mine who's a chiropractor here in Singapore, he bought $1,000 worth of Doge a few years back, and he never thought about it, slept on it. And just a few months ago, he woke up and he's like, "Geez, Kenny, my $1,000 is worth $267,000 today. What's going on? What's happening with this type of market?" And he was like, "Should I cash out?" I'm like, "I think you should cash out. I think you've done pretty well in terms of legendary crypto trades. I think they're amongst the most legendary. Obviously, he's a chiropractor by trade, but that's true wealth creation. He's now taking aside that money and putting it towards his kid's college fund. So it's a great story, and obviously not every single story is this good, but there are a lot of instances of true wealth creation, even in 2021.
Wow. I mean, who would have thought, right? It's like, that we went from just looking at Bitcoin, and now we're even taking some meme tokens seriously. I think certainly when it comes to looking at crypto, we really need to approach it from a very different perspective compared to maybe some traditional asset classes. So for some people or FIs that haven't maybe dabbled into crypto yet, what are some of the reasons that they would want to purchase crypto from a traditional bank versus a crypto exchange? Daniel, obviously you run DBS Digital Exchange. What are your views on that?
Well, I think a lot of traditional financial institutions, because of the regulated regime that they're operating, they have actually very strict AML, KYC requirements that they need to meet, right? As opposed to like an individual, right? As an individual, I may not need to, and I can take that risk, right? But as a regulated entity, whatever assets that I put my investors into, I need to make sure that it meets certain regulatory standards, right? And I think as a traditional bank, we have already operated in the regulated environment for more than 50 years, dealing with all the regulations in terms of how you can present a specific asset, meeting all the requirements of AML and CFT, right? And presenting it in a very safe, secure manner, and securing it in a custody, which the person can be sure that they can hand it on to the next generation, right? So I think for a first-time buyer, it actually gives them that security, and especially if they do not know how to navigate that space, they would come to a space which they're already familiar with in terms of their traditional asset that they are buying the equity and the fixed income from. They are storing the fixed income equity with us already. So they have that kind of comfort in dealing with that same kind of process. Right. Of course, then the more difficult hurdle for them to come on is that the onboarding process can be a lot more tedious because there's a lot more hurdles that they have to cross through. But there are some people that would a lot of financial institutions that would actually will go through those hurdles because they want that kind of security and safety, and also the assurance that whatever they purchase would have gone through certain amount of due diligence, have a certain amount of like screening in terms of AML and KYC.
Certainly. So then, Ian, when it comes to crypto trading and investment, are there certain risks that individuals or entities should be aware of? For example, looking at things like technology risks or market risks before they enter into the market.
Definitely. I mean, first of all, I must say, as much as I love crypto, we're all in this space. I think we can definitely all agree that there is a lot of risk involved, not just in terms of, the crypto asset itself being, very volatile in terms of price, but like what you mentioned, there's various technology and business risks that we need to be aware of as well. Right. So, I mean, just looking at the crypto side of things, I think, we must all be aware that crypto at the end of the day is built on blockchain, and blockchain itself at the end of the day are built by humans, right? And humans are definitely not infallible, right? So there's always going to be technology risks that comes from, let's say, the smart contract that issues the token. We've seen instances in the past where, bugs have been exploited that allows people to, manipulate the asset directly, right? We've seen instances of, these projects having the founders run away, right? Where they literally conduct an ICO just to raise funds with no intention of actually delivering on their promises, right? Which then leads to the token itself crashing. So there's business risk from the token project itself. And then coming back to as well, then the platform risk, right? So obviously, today we've come very far. In the past, when you wanted to buy cryptocurrencies, you might have to use your own private wallet, which is again, can be very challenging for a lot of people, which to Daniel's point, right, is what attracts people to use things like a traditional bank where, they have the assurance that, hey, my assets are protected by DBS, right? They've been around for a long time. And if anything goes wrong, I know that DBS has my back, right? Today, most people buy their crypto off, your typical crypto exchanges. And as far as regulation has come in to require these crypto exchanges to put in place, proper KYC, AML, cybersecurity measures, unfortunately, the reality of the fact is a lot of these exchanges still are quite lacking when you compare them to your traditional financial institutions, which is why you read about exchanges being hacked, being targeted, right? And so there's the platform risk as well. And I think one of the great thing about regulations is now that, there is this clear framework that allows these traditional institutions to come in, people now have options available to them, right? They're not just limited, hey, if I want to buy Dogecoin, I got to go into some shady exchange online. I can call up my friendly, banking relationship manager in DBS and express interest, and they can actually help me handle, right, that process.
Yeah, certainly. So Kanny, when you're speaking with clients about, fitting some of those risks into their own risk policies, how do you suggest that they do that? And, how do they manage the types of risks exposure that crypto has?
So one big thing I think maybe just to add on to Ian's point is another aspect of it is reputational risk. I would say that I guess the difference is that the maturity in the marketplace has increased exponentially, since over the last few years. Before in 2017, when I first started in the crypto industry, wasn't a lot of clear regs. Everyone was just moving as fast as possible, getting the latest ICO and just getting allocations and just making a ton of money and then running away with it. There were a lot of stories about foundations, about exchanges getting hacked. Now in 2021, I think the stakes are higher. Actually, now that you had a little bit of consolidation within the industry, you're looking at more well-capitalized firms that are looking to create a real business out of this. You have companies like Coinbase that are going public, and ourselves who are also public that has a different sort of appetite when it comes to risk. So having a little bit more transparency for that is a real big plus. But another thing is that actually the regulations that come in, whether it's Hong Kong, whether it's Singapore, they are quite clear. They are quite clear on what they want. It's sitting there black and white. How we interpret it and how we actually practically apply it is actually up to us in each of our business model. But in general, a lot of this is rooted upon the traditional lens of how, for example, how we tackle, AML, CFT compliance. It's the same principles. You make sure your KYC, make sure your KYB, even the onboarding process is very similar to how banks onboard today. So I think a lot of our clients, when we actually meet with them who are more crypto native, they're actually taken aback at how many steps are taken. So I always say, how about this? We'll slow down before we can speed up, because we want to make sure that when you run across a highly volatile market, that we can execute for you, seamlessly. We don't want to have any speed bumps. We don't want to, give you any sort of red card and say, slow down and at that point. So I think for that to happen, you have to make sure for NFIs, when they are looking for someone to execute for them, they have to make sure that the policies and the direction are sort of in line, so that everything's approved or pre-approved up front. You kind of know where they're sitting, so that when you do the execution, you just let the traders do the business. You find out what the best price is, what the best time is, and the right allocation.
Yeah, definitely. It does sound like preparation is really important. Grace, was there anything you wanted to add there?
Yes, I thought I'll briefly add on this point as well, because I'm currently managing a few crypto fund management licenses in Hong Kong. And I think Kanny is familiar with the regime there as well. And so as part of the regime, if an asset manager wants to get that additional approval from the SFC to actually manage crypto assets, essentially the Securities and Futures Commission, which is the relevant regulator in Hong Kong, would have to get comfortable with your setup, which includes the trading platforms you use, the custodians you're using, the way you're valuing, your controls and risk systems. And so I've had clients come to me and discuss on trading platforms, because more often than not, they are considering the range of trading platforms for which they want to use. And they often, say, Grace, you have to understand that, for a lot of the products we trade, the arbitrage opportunities are better on, XX unregulated exchange based on what we have noted. The flow and opportunities for benchmarking is just not available in some of the regulated exchanges in comparison. And what I would always respond for a comment like that is that, if you are pursuing this Type 9 uplift with the SFC, it's going to be unavoidable that the regulator will scrutinize very closely these arrangements you have with trading platforms and how you can ensure that you are achieving best execution or protection of your assets with the exchange, how the exchange protects the assets, how you're entering those markets, whether, market manipulation and integrity issues, which is something that I discuss a lot with, one of the contacts I have here, Vince Turcott, on how this has not been a focus in these markets in Asia, but I think it will come. So I think these are quite important if you are actually an asset manager really thinking on your engagement with the regulator in the long term as well as with your investors, because your investors also want to understand how you are generating that return and whether it's sustainable.
Yeah, that's such a good point, because I do think that, there is, especially in regimes like in Singapore and Hong Kong, with regulations in place, like, traditional finance is really looking to take advantage of innovations in the space while also staying compliant, right? So I think it is such an interesting balance to take. And I think really reflecting on the institution's risk policies is such a great first step. But I do want to kind of pivot a little bit now to talk about crypto innovation and how, of course, there's going new technologies coming out down the pipeline. Of course, DeFi that Kanny mentioned a little bit earlier is becoming more and more popular. How can FIs really take advantage of innovations and really change that access of new financial instruments through crypto? So I guess let's maybe touch on DeFi first before we go into other pieces as well. But DeFi, there's certainly a lot of discussion of DeFi eliminating banks altogether. Is that actually realistic? And what are your views on this subject? Daniel, why don't we start with you?
Well, in fact, I was just having some discussion with a friend of mine about the future of decentralized finance and how it can actually probably provide a lot of banking type services, especially in the future. But one of the hurdles I think that DeFi is going to face when you're going to move into this space is there's going to be a lot of regulatory hurdles, right? Which is why as you can see that even though most of the things that we can see, the services in the blockchain world can be presented in a decentralized model, a lot of firms are trying to put a centralized skin around them because they want to get it so it can be regulated somehow, right? Because without that wrap around it and it's completely decentralized, it's going to be very difficult to see who is going to be the regulator, which jurisdiction it is in, etc. Right? I'm sure Grace could probably add a lot more into that later on. But I think that it's very important for, at least in the near future, right, for blockchain companies providing all the services, that they need to come under some sort of regulatory regime, right, before they can actually grow very quickly. I remember back in 2018 when a lot of firms were, digital exchange was saying that you can set up an account within 10 minutes, You can just log in and get an account. And then I remember I was in Hong Kong and I met Wayne's colleague, Wayne, which is Kanny's colleague in OSL. And then he was asking me to open an account there. This is back in 2018. And he was asking me for my passport. And he was taking my photo and stuff like that. And there was a lot of things. It was like a 45 minutes thing just to get all those processes in place. Right, and this is so many years ago, and you can see that today, that's probably the right step that OSL did, right? Which they eventually helped them got that SFC license, right? And I think that is what a lot of firms would eventually need to do if they want to provide those kind of services. That they would need to put some sort of wrap around it to be centralized, to decide which jurisdictions they are operating in and which regulator to submit to.
Yeah, certainly. And I think, even if, we always tell our clients as well at Merkle, even if you don't have regulations in place at the moment, act as though there is and be compliant, and that will always, put you on the right side when it comes to regulators. So Grace, obviously DeFi is still really new, but, would love to see whether or not you had any thoughts in terms of what you think the MAS will do, whether or not they provide any guidelines or if there's any hints at how they will go about trying to regulate DeFi in Singapore.
Yeah, in fact, let me do a little, something which is, I suppose, unconventional for lawyers, because I do think that a large part of the DeFi space is not really susceptible to regulation in itself. I say that because I know the Financial Action Task Force, for instance, has put out a lot of recommendations proposing to regulate DeFi. And it has gone so far to, for example, propose that governance token holders should also be regulated if they hold governance tokens. If you facilitate the setup of a decentralized protocol, you should be regulated even if you seize control of the DAO later on, if you continue to profit from it. And basically lots of actors are proposed to be caught up in regulations. But sometimes when looking at it, I think about often the practicality of regulating. So for example, if you're looking at a simple example of DAI, right? And you're looking at the maker token. So does it mean that before and after you sell your maker token, you would have to get a license with the MES? This would be kind of a ludicrous outcome in terms of who you are proposing to regulate and whether that regulation actually makes sense. And another example is, for example, if you're looking at a lot of the different types of DeFi staking protocols, I think actually some of the substantial issues within DeFi have not really even been addressed, because going beyond AML, you really have to think about what is the purpose of the staking option, which is something that we actually look into very closely, because I think we have done almost 300 token opinions today, and a large part nowadays are all DeFi. And so we examine every DeFi protocol very closely and sort of query what is the purpose of the staking component. Is it truly a governance linked aspect, and how it all breaks down? And a lot of it is linked to models which the regulators will inherently probably not be comfortable with, like entirely black box models or some types of business models that inherently do not lend themselves to regulation. So either we decide to actually cut off a large part of the market, which means a chilling effect, or we actually find a sensible way of doing it. So I think what Access actually sought to do in the most recent response to the FedF consult was to actually find that balanced middle ground. And I think similarly, MES will also seek to find that balanced middle ground, hopefully in Singapore, or at least Access will continue proposing that to MES. But I think it's quite important that we do not throw out the baby with the bathwater, quoting someone in the group, not from me, but I thought that was a great line that I need to borrow all the time now. And we need to acknowledge the difficulties in assuming that DeFi can naturally just have a wrapper for regulations.
Yeah, certainly. That is such a great point. So in terms of FIs and traditional finance moving into crypto and really taking advantage of crypto innovation. Kanny, what are your thoughts in terms of, whether they should directly purchase crypto, or should they go through a fund or an ETF, or, should they be going through an OTC desk versus, like, there's so many options, right? So what would your suggestions be in terms of entity looking to get that exposure?
I would say the quick answer they should definitely go through an OTC desk like OSL for reliable execution. Actually, I want to just maybe touch upon the point that we were talking about DeFi. If anyone has ever tried DeFi farming, and this is something that I did over last weekend, just to see it, just feel the experience. I mean, getting your tokens, putting on the right platform, harvesting the yields, rotating, making sure that you're hedging against the price appreciation or depreciation. It's not an easy task. Like if you're getting a financial institution around it, I would say even for individuals, it's not easy. You probably might have seen around the job market on LinkedIn postings. There's actually job postings for DeFi farmers. It's an actual skill set, and it requires you to understand what protocols, like new and upcoming protocols, are offering the best yields and rotating your props so that you get those best yields. So it's not even easy from a practical application today. So to forget, I would say forget, getting FIs into this as of today. But coming back to your question about execution and getting exposure versus the fund versus Bitcoin, I would say that perhaps the fund exposure, or maybe some sort of tracker type fund, is still available. There's a lot of really good projects and products today, but that's really, I guess, as a result of some of the mandates that are given to asset managers or different funds. They want the same synthetic exposure, but they don't want to hold the underlying for some, for whatever reason. But coming back to how to do it, I think buying Bitcoin is rather easy. There's so many different exchanges, so many different desks, and so many ways to purchase. I think the main difference that maybe a lot of people who are purchasing for the first time don't fully appreciate the difference between an OTC desk and an exchange is that when you buy an exchange, you're buying peer-to-peer, and there's a slippage. When you get that price, in between the bid and the ask, you assume that's the price that you're getting at. But when you actually click the button, it's executed in multiple lots far below that price that you thought. There's also maker and taker fees on exchanges, but on average, I would say you would see more of the retail investors try to purchase small amounts to get exposure to certain tokens on exchanges. But when you get it through an OTC desk, you get single price execution. You can get what we call an all-in price, so that you don't have to worry about tiers and different fees. What you see is what you get, and you can just close off the price. I think another reason why you go through a brokerage is actually the insights that you get provided. So for OSL, we have 3 trading desks, one in Hong Kong, one in Singapore, and one in the Americas time zone, so that we can really provide that 24/7 experience. So during our morning time, our Asia desk provides you a little bit of color, a different flow, and then our Americas desk, when they get up, you say, this is what we're seeing from our desk, and you kind of see what the global flows look like. So there's a lot of seasonality between Friday nights and the weekends, and then from Asian buyers to to American buyers. And something that I've seen, I'd love to share with you all, is that the sentiment, a lot of what we see, Western buyers are very prone to news and price fluctuation, and a lot of large reaction to news. So, for example, when Elon said that I'm going to drop Bitcoin, everyone thought the whole world dropped, and you saw that huge market crash from a U.S. perspective. But then, we saw some actually positive buying flows from an Asia perspective, because value investors see, hey, I've been looking to buy in this whole time, and now there's a dip. Now I'm going to get in. So it's quite insightful, and that's a difference that you get when you work with an OTC desk versus an exchange.
Yeah, certainly. That's such a good point. And having done crypto comms in the US versus being in Asia, I definitely see a difference in terms of the way that investors approach the crypto markets. Is super interesting, and those insights, I'm sure, are super helpful to your users and your clients as well. So, on the topic of innovation and kind of how FIs are really leveraging crypto innovation. Of course, DBS is no stranger and kind of one of the first adopters when it comes to crypto and tokenization and digital assets. So of course, I'm sure a lot of our listeners that are on this webinar know that DBS announced this week that they're issuing $15 million in digital bonds in the its first security token offering. So of course, with Daniel here on our webinar, I would have to ask him about the product that they just announced. So Daniel, of course, want to get some color from you. How did this product come about, and kind of what sort of investors are you guys targeting toward for this product? Who would benefit from this, that sort of thing? Would you like to get started?
Thank you. No, I think the security token offering is something that we think that how traditional is one of the things that how traditional capital markets will move towards, right? It's a way that you can see how, especially how we can raise money. But like, for example, you're already raising a lot of money from for private equities, right? And security token allow you to democratize that and also issue it in much smaller chunks as well. Right, so we think that this is a way forward. So that's the reason why we actually move into this space. For the types of investors that we actually place to, they are mostly high net worth and institutional investors, because when you do an STO, we are actually doing an issuance without a prospectus. So in order for you to hit retail, you need a full prospectus, right? So in that case, you might as well go for a full IPO. But for security tokens, there are actually a lot of advantage. For example, if let's say I do a private equity, I purchase a private equity investment, and then I find that actually Kanny wants to buy it from me, right? We would need to move into a discussion with Kanny, and then there would be like I'll need to get a lawyer involved to get the S&P to be done, which means then I'll need Kanny would need to have to buy in a certain size to make it meaningful as well. But with security tokens, you don't need that, right? You can transact it immediately. You can even do smaller chunks, and then the transfer of ownership would actually occur once you the tokens actually transferred to you.
Got it. So can you talk a little bit about kind of what went into building this product? Like, let's start off with the blockchain technology behind this digital bond that you guys are creating.
This is actually the DBS blockchain is actually based on Ethereum. Right, the tokens are ERC 777, and these are all built in-house by the DBS tech team.
Got it. Understood. And so then how does an institution like a bank go about, creating a token offering like this? Because obviously I think a lot of institutions think that STOs can be a great way to kind of move into the digital asset space. It is definitely very difficult to align everything within the organization. Can you give us a little bit of insight here in terms of how you went about and the process of doing so?
Okay, the technology for security token, I think to most people in the technology space would think of it a bit as fairly the easier portion. But I think the more difficult portion is actually the traditional investment banking work that needs to get into a deal. As you see, like, the difference between a security token and say an ICO is that a security token is highly regulated. You have to follow everything within the Security Futures Act, right? There are blackout periods, etc. So these are things that investment banking teams are actually very familiar with. So in terms of preparing for the deal and structuring the deal, you still need a lot of traditional investment banking work going into a deal, whether it's equity, real assets, or fixed income. And what we have done within DBS is that we have used a traditional team that we have from our capital markets, which looks after both the equity and real estate investments, and also the original team from our fixed income team from Treasury and Markets to be involved in this project. So if it's a fixed income deal, the team from the fixed income original team in Treasury and Markets will actually work and structure the deal. If it's going to be an equity deal or a real asset deal, it's going to be done by our capital markets investment bankers. So all the structuring parts are the very important thing. And I think the good thing as a bank is that we already have those teams in place. So we can leverage on those teams to do most of those work. Because once they have finished the work, what we then need to do then is just simply issuing that token, right? And the token just represent it. But the most difficult part, I would say, is to make sure that the traditional investment banking work actually go into that deal, the valuation, the structuring, etc.
That is so interesting. Like the fact that we are really talking about traditional ways in which, banking is done, and really putting a layer of technology to really help improve the way that, it can be traded afterward, and that back end. That's fascinating. So I know that, this might be not within your purview directly, but I know that within crypto, there are also areas within DBS where you guys are leveraging this. For example, the DBS private bank launched a trust solution. You may not be able to dive deep into this as it's, probably another group's product, but can you talk a little bit about, the objective of it, and, where can listeners learn more about this trust product?
Oh, okay. First of all, it says that, the DBS exchange, we work as a members only exchange. And what we do is that we allowed different members within the DBS exchange to actually come up with a new product. So like DBS Private Banking is actually a member of DBS Exchange, and they have actually come up with this product of their own, right? So the objective of the product is actually to allow, it's like traditional trust, right? So like a rich man like Kanny, he has lots of money. He wants to ensure that his kids actually get to enjoy that as well. So what happens is that in a traditional environment, what you do is that you put your equity, you put your asset into some sort of trust to ensure that your next generation will get to enjoy it, right? So what we are doing is that we are extending that service to include digital assets.
Got it. That's really cool.
Hey, Gaby, if I can just jump in here and maybe say two of the things that Daniel is not willing to say, is that it's just been a fantastic offering for the marketplace. I think there's just so much interest from the what we call the traditional crypto investor. They're like, this is so interesting, right? Just the convergence of the traditional finance market into the crypto markets. Now you really have sort of this hybrid product that really makes the market think about, hey, actually there's so much more to come. I think one of the during the announcement said, this is just the beginning, right? Offering a low yield coupon on a bond. Maybe for traditional investors, the yield is not so great. Maybe from that perspective, is not so interesting. But the fact that this is being offered by the #1 digital bank in the world, by the #1 bank in Singapore, to accredited investors, it's amazing. It's a big milestone for us in 2021, and we should really all sit back and recognize that fact.
Yeah, absolutely. I totally agree. And I think sorry. Okay. Yeah, no, I totally agree. And I think I think the MAS and kind of the regulations that are in place, and certainly encouraging the environment to be more innovative within the space, has really been helpful in kind of encouraging these innovations and products, and for traditional finance to really move into the space. So thank you very much for sharing that insight, Daniel. Like that's really great, and thanks, Kanny, for your thoughts there. So before we move into the Q&A, if the listeners have any questions for our panel in a few minutes, wanted to quickly discuss kind of the latest FATF guidance. Of course, in March, the FATF updated its draft guidance, and will come out with the updated guidance in June. Ian, are there certain areas that the FATF is really focusing on this time around, and how will it impact Singapore regulations, do you think?
Sure. So definitely, earlier this year, FATF had put out a consultation proposing to expand some of the recommendations that they had released previously. And to be very honest, some of the recommendations that they've made are quite drastic, right? So I think one of the things that they wanted to address is the current gap, in the sense that, under the previous recommendations, certain businesses like your decentralized exchanges, your DeFi platforms were not covered under that ambit, right? And so, we touched upon this a little bit previously. Grace kindly shared, some of the things that they proposed, which is that, aside from looking at a legal entity, let's look at who else are stakeholders involved, be it the developers, be it management, who contributed to bringing those platforms alive, right? And the proposal today is that, if it goes true, some of these developers or management could potentially need to be regulated as fast. And I think, this can have a chilling effect on the industry if it does goes to light, because, one of the exciting things about blockchain today is that, developers can innovate very quickly. They can build exciting new products, people can access it. And if this regulation comes to pass, people are now going to have second thoughts, right? People are going to be afraid to build new products because they're going to be afraid that, hey, I may end up requiring to be licensed. And if I'm not, then I'm breaking the law, right? On top of that, other areas which FATF have looked at would be the risk of unhosted wallets. And by unhosted wallets, we're really referring to private wallets, right? And I think those of you who follow the crypto space, one of the things that was exciting about crypto in the early days is creating this way for people to take full control of their assets, right? And you do that by having your own private wallets. And if the if the new proposal comes in, there's going to be a lot of increased scrutiny that comes from these unhosted wallets, with the proposal even going so far as to recommend that one of the ways that jurisdictions can guard against the risk of unhosted wallets is to deny licenses to VAST that allow transactions from these unhosted wallets, which I think is really taking it a step too far. And so, as part of various different organizations, I think the industry has written back to address these issues, because it really goes against what blockchain is all about. But we must be, we must recognize that this may come to pass. And how that's going to impact us in Singapore is, as great as Singapore is in creating this safe environment, which has spurred and attracted all these VAST to come here and get licensed, one thing that we must recognize is that Singapore is very close to FATF, right? A lot of the requirements under our current licensing framework is directly taken from FATF, things like travel rule, right? We were one of the first countries in the entire world to implement this. And that's because, again, Singapore does very closely adhere to the recommendations that FATF put out, which means that if all this comes to pass, 2022 may look very different, where a lot of the businesses in Singapore would need to have in place, different processes to deal with unhosted wallets. You may see exchanges now not being able to accept transactions from these unhosted wallets, or perhaps not even allowed to deal with DeFi platforms, because under Singapore law, if they follow the FATF recommendations, all these platforms are basically operating illegally. That being said, I think that's one of the exciting things that, one of the good things, of course, is that with these financial institutions coming in, these financial institutions are obviously used to being regulated, right? And we're seeing a lot of these financial institutions look to DeFi and look to these existing blockchain projects as inspirations. And I'm very hopeful to see, local businesses, regulated businesses start adopting and copying those products, but offering it in a way that is in line with what regulation entails, right? So hopefully, we'll still be able to get all the benefits, but via, these regulated entities.
Yeah, certainly. Grace, I know kind of like as a board member at Access, you certainly straddle the two sides and really hear from both the industry and MAS in terms of, their thoughts on innovation within the crypto space. What are your thoughts on kind of like how MAS is approaching things, and what the conversations have been like going back and forth between industry and MAS?
Sure. So I think, as Ian has alluded, I think MAS does place a lot of emphasis on the FATF recommendations. So as an example of that, when the travel rule recommendations came out, I think MAS was one of the first jurisdictions in the region, at least, to actually implement a version of that in the value transfer requirements. But of course, in terms of implementation and guidance, Singapore was also one of the very first jurisdictions, as I noted in my tracker, to actually allude to some aspects on how you have to check on unhosted wallets or impose additional controls and guidance. But I think some of the practical questions and implementation is what the industry would likely struggle with. So for example, some questions are still unresolved in Singapore, like the treatment of stable coins. That still remains unresolved, and MES has not yet released the consultation response as yet. Issues in relation to the practical implementation of the travel rule for unhosted wallets. I do know at least one of the main travel rule solution providers has a fix for that. It does not cover all types of wallets, but in terms of interoperability, do you want sections of different groups in industry all operating within each sector and not really interacting with each other? Is this where we want the industry to lead to? Essentially, this is what we have been calling the sunrise problem, right? So I think in the tokenized securities world, which Kanny and Daniel have been alluding to, a lot of the solutions in relation to that is to create a KYC type wallet where a lot of the aspects are resolved because you have a closed loop chain. But it is harder to look at the crypto industry as a pure crypto loop chain unless you're thinking of memberships, private memberships all the time in the industry. And essentially that may create quite a lot of difficulties. So I think for MES, I think being ex-MES counsel for many years, I was there for around 5 years. I always hope that the regulator will seek to achieve something that is an ideal balance between regulation and innovation. And I know MES is often praised by a lot of my clients for doing exactly that, but I must admit that it has its challenges set up. And if you're looking at Hong Kong, for instance, and I'll briefly mention Hong Kong because a lot of my clients have been recently talking about the FSTB regime, which has just been introduced to follow after the FedF recommendations. Well, interestingly, a lot of the focus has been on exchanges, which is really different from the Singapore approach entirely. And that only goes to show how a different approach in a different jurisdiction could lead to difficulties for a lot of players operating in different jurisdictions on how they think about their business strategy, their regulation strategy, and even how they perform compliance on a day-to-day basis. And even for tokenized securities, I think this is why we lawyers are so involved in advising on cross-border offering requirements for reverse inquiry and other aspects. Yeah.
Got it. That's fascinating. So we did have a question come in, so the question says, why would a decentralized bank need to be regulated given the services are run by code? Is there anyone who would like to take this question on?
I mean, I'm happy to offer my opinion. So I think, first we need to recognize the purpose behind the law, right? The law isn't there just to regulate whatever it thinks it needs to be regulated. The law is there to, create a safe environment to guard against, bad actors and criminal activity, right? And so the reason why a decentralized bank would need to be regulated is not because, it's run by code, it's not run by people, it's because there is risk involved. Right? If you are taking in assets from, external parties and you are then doing something with it and then giving it out, there's going to be risk that bad actors are going to utilize the service that you're providing in order to launder their illicit gains. And it's the risk that it poses that requires it to be regulated, right? It's nothing else. It's just that, right? Because we don't want a world where, these criminals have access to tools that allows them to conduct and facilitate their money laundering with ease. We need to at least do best efforts to deter against that. And it's because of all the risk that these DeFi platforms and decentralized exchanges poses by, having a system that's run by code, which means that anybody can send assets in and receive it without any checks and balances. That's the reason why we need to find some way to prevent and guard against, these activities.
Kanny, I think you're on mute.
Yeah, sorry about that. Yeah, maybe I was going to just add a little bit about the accountability portion of it. I guess in a decentralized bank, yeah, it'll be super efficient. Everything's run by code. You have triggers. You have everything on smart contract. Everything's super, super transparent. But I guess the idea is that when things don't go the way it was intended, that systemic risk is posed. Where is the accountability? as humans, that are still running banks today, there's a lot of accountability. The MAS wants to know, who's the RO, who's the MIC. These constructs are put in place so that when there's something that doesn't go quite right, there's a lot of engagement to say, let's maybe get you on the right path, or let me clarify what we wanted. So having that accountability actually puts ourselves into be more responsibility to be regulated, and I think that's what it means.
I'll briefly mention that the original iteration of the FATF recommendations actually did not include decentralized platforms within scope. It was only later when DeFi took off that they decided that perhaps DeFi should also be within scope. So I think that's quite important to know. Yeah.
Yeah, and it'll keep changing, I think, as innovations within crypto keep evolving and become more popular. So we had another question come in. What is your opinion of some regulators considering only allowing professional or accredited investors access to crypto? So I think this may be in reference to the latest from Hong Kong, in terms of like them only allowing institutional or accredited investors to trade on crypto exchanges. Any thoughts from our panel?
Yeah, maybe I can take that on, because we do have, as OSL, we do have a license in Hong Kong. We have the first and only digital asset license, type 1 and type 9 in Hong Kong. And we only onboard professional investors. That's part of the SFC requirements, and that's something that allows us to actually, if you think about it from a regime perspective, allows us to actually engage with the cryptocurrency retail, or sort of the cryptocurrency market in general. I think it's still a landmark case. There's been, if you look back at 5 years ago when we had, maybe 10 years ago, when we had the sort of the Lehman mini bond crisis. At that point, there was a lot less sort of issues in terms of mis-selling, and then all came to a head. There was a lot of issues because there was a lot of antis in the market saying that, hey, I lost my life savings, not my investment savings, my life savings, to mini bonds that I wasn't so aware of. So now that we recognize the risk of these cryptocurrencies, we want to make sure that you put in the hands of professional investors who understand the risk of what they're dealing with, and that's one way for them to actually participate in a large-scale manner. So it's a way forward, is how I see it.
Yeah, I'll briefly add in a bit here, because I would say that the Hong Kong environment is also a bit special, because in the past, a lot of exchanges used to try to get regulated under the money service operator regime. And so I remember 5 years ago when I was looking at the regime, there were some of them all operating as MSOs. We had a client who was operating as one as that, and we had ENX, and some of the other operators as well. So I think a lot of the news which reaches out to the regulators has been negative in terms of the crypto industry, which is a little bit unfortunate in Hong Kong. And some of the weird stories, like for example, a crypto exchange owner who threw lots of cash from the top of an apartment building, does not really help to paint the crypto industry in better light. But I would also note that, there are some numbers which are put out. For example, the Bitcoin Association of Hong Kong noted that professional investors constitute only 2% of the entire Hong Kong population. I mean, I've not done a calculation myself, but I do suspect that that may be a bit limiting to only limit it to professional investors. It may be that this is the first round of the SFC trying to get sense and comfortable of where the industry is. But I do suspect that, if this is continuing to be the case, once again, the chilling effect of investors going overseas and using overseas platform, as far as I can tell from my contemporaries, everyone is using some kind of device or other, and there are ways to get around it. So you do have to tackle the problem head on.
Yeah, certainly. Well, we are coming to the end of the hour. That was certainly a very interesting conversation. I really appreciate everyone's time. Just to wrap everything off, I want to ask our panelists just one question. What areas of crypto do you find the most exciting and that you think the crowd should pay attention to in the next 6 months to a year? Kanny, do you want to get us started on that?
I mean, I guess there's a lot of different areas. It's supremely innovative. I think security tokens is one aspect. I think with what DBS is doing and what we're doing in Hong Kong, I think that's certainly interesting for a certain class of investors. Maybe not for everyone, but people who are interested in investing into traditional securities might find that somewhat appealing. But I guess if we talk about sort of crypto natives, they might go into certain layer 2 type of protocols, different type of tokens that solve some of the Ethereum scaling issues. They're looking for newer, better, smarter contract for them to have their blockchain projects or dApps, as we call it, put on. So I think that's going to be super exciting. What actually sort of shakes out, which token, which protocol sort of shakes out. There's a lot of different bets, as you will, going into the marketplace. I find it interesting. And obviously, another thing that I guess we haven't really touched upon was NFTs, non-fungible tokens. You had the biggest non-fungible token sold right here in Singapore, just not too long ago, and that is something that might be interesting in the marketplace. In terms of what we're doing in Art Week, there's some really interesting announcements from an NFT perspective, and maybe that will take hold. So I would say in general, just so many different things. Hard to keep track of all of it, but it's good to at least understand a little bit of everything so that you can say whatever comes at us, in the future from a digital perspective, we're ready for it.
Absolutely. Daniel, do you have any thoughts on that?
Well, I mean, for me, obviously, I think things that we would like to develop, like, things like security tokens, probably move into some sort of a more regulated derivative space in terms of offering some sort of structured products wrapping around cryptos. But I think what I would like to see more in the overall space would be like the simplification of how to access like DeFi and more decentralized protocols. Because I mean, just imagine, like, if I were to explain to my mother how she can go and buy some Ethereum, go to SushiSwap, and go and get into some sort of, to access a decentralized protocol. It's just too difficult today, right? I would like to see, some sort of simplification, and I believe there'll be firms that are moving into that area where it makes some sort of interface, make it a lot easier for people to access that space. Because at this point in time, you can see that space will be like very limited to a selected group of like more tech savvy people like Kanny.
Who has
and his friends.
circumvented sushi and pancakes and everything.
Pancakes,
Yes.
get all your bakery tokens out.
Yeah, you talk about something like that to a banker, they probably haven't even heard about it before. If I talk about Uniswap to a banker, they would have not heard about it before.
Yeah, absolutely. And I think, with the DeFi become more popular, like, I certainly think that will probably be the next steps. Grace, do you have any thoughts on kind of like what would you find the most exciting and what people should pay attention to?
Yeah, I'll briefly add on to what Daniel said as well, because I think we also have to remember that even as you make it more simple, ironically, I think we also have to make sure it's not too simple, that the risks are also highlighted to investors, because I think one of the problems is that when you get too simple, like Robinhood, you do see a lot of, more vulnerable groups in the industry also get sucked up, especially it's quite addictive looking at crypto. I look at it before I sleep and when I wake up, so I totally understand. So definitely, I would say in this space, it is very exciting times. I've been following digital assets and working with entities for, I think, almost 5 years or more in this space now, and definitely every year has been a different iteration of something very different. So I would say it's very exciting times for digital assets. I think there will be only more to grow going ahead.
Yeah, certainly. It is always a balance between access and kind of protecting investors, isn't it? And last but not least, Ian.
I mean, for me, I think NFTs. I think, the NFT wave may have seemed to have come and gone, but I think we're just scratching the surface on what it can do. Too many of the NFTs today are really just leveraging on marketing, pumps and dumps, and it's going away. But I think when we actually really start looking into what it can do, which is digitalizing certain digital rights and perhaps creating a secondary market for that. And to give you one very interesting example that I heard, what if I could buy, 10 seconds of LeBron James slam dunk that won some NBA, and that 10-second rights allows me to then rent it out to advertising companies who want to buy that right as part of their advertising, marketing scheme, right? I think that's something that hasn't yet been explored, but for us to get there, all these regulations around the NFT also need to be put in place, because one thing that I'm seeing today is when people buy NFT, they think they get ABC rights. Actually, they don't. All they're getting is a token, right? It's an illusion. And when we can start connecting the dots and attaching legal rights to these NFTs, we're going to see a lot of new exciting products being developed off the back of that.
Excellent. Yeah, well, thank you very much. I think that is our conclusion to our webinar today. Thank you so much to our excellent panel for such an interesting discussion. Certainly, if there are any questions that we haven't answered, we'll look to answer them in a follow-up email to everybody. But yes, thank you very much, and enjoy the rest of your day. And everyone who's registered, we will be sending a recording of this webinar as well. So be on the lookout for that, and thanks again.
Bye.
Hey, everyone.
Thanks,
Have a
Gaby.
good day.
Thanks.